Ever feel like some doors in life are just locked shut? You see other people breezing through, unlocking opportunities, while you're stuck jiggling the handle. Maybe it's a new apartment, a dream car, or even just a better phone plan. What if I told you the key isn't made of metal, but of numbers? This is your credit score, and it's one of the most powerful, yet invisible, tools you have. Today, we're going to mold this mysterious number out of clay and show you exactly how to shape it into a master key for your financial future. So, what exactly is this magical number? Imagine your financial life is like a trust exercise. Every time you borrow money, whether it's with a credit card or a loan, you're telling a lender, "Trust me, I'll pay you back." Your credit score is basically a grade on how trustworthy you are. In the US and many other places, this score usually ranges from 300 to 850. A low score, say 300, is like showing up to a trust fall with a history of letting people hit the floor. Not great. But a high score, like an 850, that's like being the person who not only catches their friend, but also has a comfy pillow ready. Lenders love that person. These scores are calculated by three main companies or credit bureaus: Experian, Equifax, and TransUnion. Think of them as three judges, each keeping their own scorecard on your financial habits. They gather information from banks, credit card companies, and other lenders to build your credit report. Your credit report is the detailed storybook of your borrowing history, and a credit score is the one-number summary on the back cover. It's what lenders look at first to quickly decide if they want to work with you. So, why should you even care about this number? A good credit score is like having a VIP pass in the world of finance. It unlocks lower interest rates. Let's imagine two clay people, Sam and Alex, both want to buy the same car. Sam has a high credit score, so the bank offers him a loan with a low interest rate, like a gentle, small hill he has to climb. Alex, with a lower score, gets a loan with a high interest rate, which is like a steep, treacherous mountain. Over time, Alex will end up paying thousands more for the exact same car, just because of that higher interest rate. Your score doesn't just affect big loans, it can influence car insurance rates, whether a landlord will rent to you, and even some job applications. It's a measure of your reliability that extends far beyond just banking. Now for the fun part. How is this score actually built? It's not as complicated as it sounds. Let's break it down into 5 clay ingredients that make up the recipe for your credit score. The biggest and most important ingredient, making up 35% of your score, is your payment history. This is simple. Do you pay your bills on time? Every on-time payment is like adding a strong, solid brick to your financial foundation. A late payment? That's like taking a brick out, making the whole structure a little weaker. Even one late payment can have a significant impact. So paying on time, every time, is the golden rule. The second biggest ingredient, at 30%, is amounts owed, or what's often called your credit utilization ratio. That sounds fancy, but it's just the percentage of your available credit that you're currently using. Imagine your credit limit is a bucket that can hold $1,000 of water. If you've used $300, your utilization is 30%. Financial experts recommend keeping this number below 30%. Using too much of your available credit can look like you're financially stretched, which makes lenders nervous. Think of it as leaving some breathing room in your bucket. It shows you're not desperate for every last drop. Next up, at 15%, is the length of your credit history. The longer you've responsibly managed credit, the better. Lenders like to see a long track record. This is why it's often a bad idea to close your oldest credit card, even if you don't use it much. That old card is like a wise, old tree in your financial garden. It shows stability and history. Closing it is like chopping it down, which can shorten your credit history and potentially lower your score. Then we have credit mix, which accounts for 10% of your score. Lenders like to see that you can handle different types of credit responsibly, like credit cards, a student loan, or a car loan. It's like being a chef who can cook various types of cuisines, not just one dish. It shows versatility and experience. However, don't go opening new accounts just for the sake of it. This is something that tends to build naturally over time. Finally, the last 10% is new credit. This refers to how many new accounts you've opened recently or how many times you've applied for credit. Every time you apply for a new loan or credit card, it usually results in a hard inquiry on your report. It's like a little flag that says, hey, this person is looking for more credit. 1 or 2 is fine, but applying for 5 cards in 1 month, that looks risky, as if you're suddenly in financial trouble. It's like frantically trying to borrow money from all your friends at once. It makes people wary. Okay, that was a lot of information, but how do you actually put this into practice? Let's talk about 3 simple, powerful habits you can start today to build a fantastic credit score. First, and I can't say this enough, pay your bills on time. Every single time. This is the bedrock of good credit. The easiest way to do this is to set up automatic payments for at least the minimum amount due. Think of it as putting your good habits on autopilot. Your phone bill, your credit card, your student loan, automate them all. That way, even if you forget, the machines won't. This single habit has the biggest positive impact on your score. Second, keep your credit utilization low. Remember the bucket analogy? Don't let your debt fill it to the brim. A great rule of thumb is to stay under 30% of your limit on each card. If you have a card with a $1,000 limit, try to keep your balance below $300. If you do have a high balance, focus on paying it down as quickly as possible. Another trick is to ask for a credit limit increase. If your bucket gets bigger but your water level stays the same, your utilization percentage goes down. But be careful, don't use a bigger limit as an excuse to spend more. Third, become your own financial detective and regularly check your credit report. You are legally entitled to a free report from each of the 3 bureaus every year. You can get them from the official site, annualcreditreport.com. Schedule it in your calendar, maybe every 4 months you check one bureau. When you get your report, look for any errors. Is there an account you don't recognize? A late payment you know you paid on time? Mistakes happen, and they can hurt your score. If you find an error, dispute it with the credit bureau. Cleaning up your report is like weeding your financial garden. It helps everything grow stronger. Let's recap what we've learned today. Your credit score is a number that represents your trustworthiness to lenders. A high score acts like a key, unlocking better interest rates and more financial opportunities. We learned it's built on 5 key factors, your payment history the most important, how much credit you use, the length of your history, your mix of credit types, and any new credit applications. And the best part is, you are in control. By building 3 simple habits: paying bills on time, keeping your balances low, and checking your reports for errors, you can shape your score into a powerful tool. It's not about being perfect overnight. It's about building small, consistent habits that add up over time, just like small pieces of clay coming together to form a masterpiece. Thank you so much for joining us at Clayconomics today. We hope we've demystified the world of credit scores for you. If you found this helpful, please give this video a thumbs up and hit that subscribe button so you don't miss our next lesson. And we'd love to hear from you in the comments. What's one thing you learned today that you're going to put into practice? See you next time.